Good afternoon to our participants from Europe and a very good morning to those dialing in from North America. Welcome to the first EMD webinar of 2025 by J. Stern & Company. My name is Som Bhattacharya and I'm very delighted to be joined by both the portfolio managers for our emerging market debt strategy, Jean-Yves Cheroux and Charles Gélinet. We have a rich and exciting presentation for you today, and I'll shortly be handing over the rein to Jean-Yves and Charles. But I did want to spend just a minute on J. Stern & Company for those of you who perhaps don't know our firm too well. J. Stern & Company is an independent asset manager based in London and backed by the Stern family, a historic European banking family that has a long track record of investing in quality assets. While most of our investment professionals are based in London, we also have offices in Malta, Zurich, and New York. In total, we manage about $2.1 billion as of end of February across three main strategies: global equity, emerging market debt, and football financing, all with excellent track records. We rely on high-quality proprietary credit research by experienced analysts in our team. Last but not the least, one of the important differentiations for our firm remains that the Stern family co-invests up to 20% in all the strategies, thereby creating a powerful alignment of interest between clients and the Stern family and partners. With that, I'd like to invite the PMs to take you through the presentation. As ever, please feel free to submit any questions you may have. We would answer as many as we can in this webinar, and we can come back to you individually on the rest. With that, can I just hand it over to Jean-Yves and Charles to take it from there?
Thank you, Som, and welcome again to everyone who's joined. Today, we're going to talk about the performance of our EM debt strategy, why we think there's a compelling opportunity now, and our outlook. But before we do that, we thought it would be good to start by giving a quick reminder of what the strategy is all about. Firstly, the strategy invests purely in hard currency emerging market corporate bonds. The objective is to generate attractive risk-adjusted returns, primarily through income yield and capital appreciation. The strategy targets low volatility, primarily through credit selection and managing duration. The portfolio is then built around 40 to 50 high-conviction investment ideas based on our bottom-up fundamental research. And it's also actively managed to take advantage of any idiosyncratic opportunities as and when they arise. Lastly, no derivatives are used in the strategy, and the strategy offers daily liquidity to its investors. With that, we can now turn to the performance. The first thing we'd like to point out and highlight is the strong returns generated on both an absolute and relative basis. On an absolute basis, the returns were particularly strong during 2024, up 10.6% net of fees in US dollars. On a relative basis, this means we significantly outperformed the comparator and rank in the first decile compared to the peer group over all respective periods. Turning to risk, as measured by volatility, we have been able to generate the returns by at the same time as maintaining a very low volatility, significantly lower than that of other asset classes. Specifically, you can see that the strategy volatility has been 6.3% annualized since inception, which is lower than the likes of emerging market sovereign bonds, also developed market IG and high yield, and even less volatile than US Treasury markets over the same period. So this combination of strong returns and low volatility provide for very attractive risk-adjusted returns. Now, sticking with performance, it's also worth highlighting that the outperformance versus other areas of fixed income, specifically in 2024, we outperformed both the investment grade and high yield components of developed market US markets, which is something we're very proud of. Also, I think something we like to talk about is the high degree of visibility we have on these returns, primarily due to the high income yield and the low duration of the strategy. And if we rewind 12 months, we started the year with 11% yield to maturity and a 7.6% income yield. Fast forward to the end of the year, the total return comprised of a 7.2% income yield and 4.4% capital appreciation, which is the overall return of 10.6%. So again, we had very strong conviction and strong visibility on those returns going into the year. Now, turning to the attribution. Returns have been supported by bottom-up idiosyncratic credit stories and, from the top-down perspective, a macro environment where interest rates were relatively stable. Key takeaways here are performance was driven by companies from different geographies and sectors, highlighting the diversification of the underlying holdings. No one company is driving the overall performance of the strategy. Rather, it is broad-based, with most companies contributing positively. And finally, we continue to believe in the underlying investment theses for the detractors seen on the right table, and expect to see a recovery over time with these holdings. Now, if we just move on to the next page, and our simple, repeatable, and robust investment process have helped us deliver an asymmetric return profile. This means we capture more upside than downside of the market. You can see in 2020, 2023, and 2024, we captured most, if not all, of the upside of the asset class. And maybe more importantly, in 2021 and 2022, where the market was down, we did significantly better. 2022 is a good example where our credit selection and duration management helped drive the alpha. Specifically, we avoided Russian corporates, and we also avoided Chinese property, which were two of the main pitfalls that year. At the same time, we kept duration short at a time when interest rates were rising. The combination of that helped to drive the alpha you see there in 2022. Now, looking at a more recent time frame, specifically from the run-in of the US presidential elections, when the markets started to price in a Donald Trump victory at the beginning of October last year, the returns may surprise some. Naturally, there were concerns about what a Trump victory meant for emerging markets. This has been reflected in the performance of EM equities, EM currencies, and EM local currency bonds, which you can see there on the left of the chart, some of the worst performers over this period. However, the picture is very different for EM hard currency bonds, and specifically our strategy, which has fared much better. We think sometimes the perception of risk is greater than the actual risks of emerging market hard currency corporate bonds, and this is a clear example of this. With that, I'll pause and pass over to Jean-Yves, who is going to explain why we believe the asset class and our strategy in particular offer a compelling case for investment today.
Good afternoon, all, and good morning for those in North America, and thank you, Charles. We see 6 main reasons or strong reasons why we would advise to invest in our strategy. First of all, and as Charles already demonstrated, the resilience of the asset class with a low volatility over the last 20 years, but as well superior downside protection in case of high volatility, as it is somewhat the case at the moment. We believe that after 2 years of strong performance, we are still, or present still, an attractive entry point with above average income yield, which is in excess of 8% for current yield, and expected return in excess of 9%. The asset class as well has had a superior long-term track record and profile return, 8% per annum over the last 20 years, only beaten by US equities, which delivered 10%. As Charles just mentioned, the perceived risk seems to be greater than the actual risk. And if you compare the asset class, the high yield portion of the asset class relative to US high yield, you will see that balance sheet of the corporates are often much stronger than the US counterparts, and the default rates lower. There is also a low correlation with other asset classes across the board, which means that this asset class is or should be one of the key ingredients into a mix of assets for all investors. And last but not least, this is an asset class that has evolved tremendously over the last 20 years. Initially very linked to commodities and the energy sector, it has diversified now into other sectors, and will demonstrate that, which are actually quite solid and attractive. But most importantly as well, it has developed in terms of size, and now the EM corporate debt sector or asset class in general is actually greater in terms of size than the US high yield, which is somewhat surprising for a lot of people. Downside protection, we already mentioned the resilience, and even in periods of high volatility. And what we're trying to demonstrate here, if you remember last year in August 2024, some of us had the nasty surprise waking up in the morning to see that the Japanese market was down 12% in a day. And as a result, the US market and other markets were down around 8% for a couple of days. What happened there is essentially the volatility rise very, very substantially to the level of 66 you see on the right-hand side here. And this is the volatility index called the VIX. What we decided to do is to look in the past at comparable periods of time where the VIX went very sharply over a short period of time. And as you can see here, for example, on the left-hand side, you've got in 2008, the Lehman crisis. Then you have in 2020, the COVID crisis, 2022, again, Russia invades Ukraine. So very, very distinctive periods. What is interesting is that the blue chart or dark blue chart or bar indicates the performance peak to trough of the S&P 500. And as you can see, for example, in 2008, the index was down in excess of 50%. For the same period, the gray bar with corporate, EM corporate, was down around 10%, or it's slightly in excess of 10%. But if you compare for each of those periods, you will see that the volatility buffer that this asset class provided was actually very, very attractive. Now, if we look at the relative risk return, the last 10 years, first of all, to start, which is on the left-hand side, as you can realize, US equity had exceptional return, which are in the region of, which is essentially in the region of 10% plus, but relatively high volatility in the region of 70%, as you would expect. However, obviously the fixed income pocket, which is at the bottom left, has much lower return, and essentially that was due to an environment where interest rates were very close to zero, and the EM debt corporates were actually no exception, but still generating around 4%. Now, if you look forward and you look at the next 10 years and expectations, what you can see is theoretically US equities are still expected to have great return. However, the duration for those are actually much longer. But our EM debt strategy, we expect as a yield to maturity, which is in the region of 9%, as already mentioned before. However, with a very, very short duration of 2.5 years. Okay, so this is what we found really attractive at the moment, is the high degree of volatility, and Charles will come back to that. Now, I mentioned the less correlated aspect of the asset class, and as you can see on the next slide, the mix of, or mixing this asset class with other assets provide actually great returns. And if you can see at the bottom range here, a 50-50 asset breakdown in terms of allocation between equities and the EM debt strategy provide equity-like return in a region of like 9.7%, so very close to 10%, but the volatility is around 60% of the volatility of the equity market. So if you position that on an efficient market like chart, which is the case on the left-hand side, you will see that straight away the profile is very, very attractive. And obviously the mix could be very, very different depending of your expected risk return or what you're trying to achieve. But again, a very attractive profile. Now, Charles is going to take over again to talk about the outlook and the positioning of the portfolio and the strategy. Charles.
Thank you, Jean-Yves. So looking forward, we believe the focus really will remain on President Trump and economic growth. Policies are likely to be inflationary, and as a result, we're expecting interest rates to remain higher for longer. Turning to emerging markets specifically, importantly, credit fundamentals are in very good shape and default rates are in check. With regards to valuations, credit spreads reflect those credit fundamentals, and all-in yields still look attractive in our opinion. On a relative basis as well, when you look at spreads, EM high yield looks fair versus US high yield. So both on an absolute and relative basis, we think spreads look okay. And importantly, the technicals are supportive. we've seen outflows to the asset class over recent years, which mean asset class positioning is light, and there are few incremental sellers. This is quite the opposite of what can be seen in equity markets in the last few days. Now, thinking about Trump and the impact it could have on emerging markets, we look at the three key regions and rank them in terms of vulnerability. Unsurprisingly, Asia is likely to be the most impacted, with China in the crosshairs, specifically around tariffs. Then you've got Latin America, which we think will be a bit more mixed. Most questions will be on Mexico, given tariff headlines. And then lastly, Central Europe, Middle East, and Africa, which we expect to be the least vulnerable. You look at Turkey, which is the only significant non-commodity exporter. And then there's also potential resolutions on Israel, Gaza, Russia, Ukraine, which could potentially provide upside there. So with that in mind, what does that mean for our portfolio? You can see there on the top right table, which illustrates the strategy exposure, which is very much tilted towards the regions which we've just outlined as being the least vulnerable, primarily Latin America and CEMEA. And then if we look at tariff risk specifically, we feel very comfortable, given one, there is zero exposure to China. And then if we look at Mexico more specifically, which represents 14% of our strategy, we've got six companies that make up that 14%, of which five effectively have zero exports to the US. As you can see, there's a range of domestically orientated companies like Alsea, which is a restaurant operator, and you've also got other companies like Cemex, which is a building materials company, which have increasingly established operations in the US, which reduces this tariff risk. What it means overall, on a weighted average basis, if we look at the strategy, only 1% of our company's gross revenues are exposed to tariffs. So again, very manageable in our opinion. Now, looking at the portfolio from a different angle, and we look at the characteristics of a few key points to make, given our views on the moderation of global growth potentially. Firstly, around 80% of the portfolio is invested in the safer part of the capital structure, i.e. the first lien secured and senior unsecured bonds. Second, we have been increasing exposure to more defensive, non-cyclical sectors, such as consumer staples, communications, and industrials. And finally, our short duration and attractive income yield provide a buffer to potentially broader market volatility, which again, we think puts us in very good stead going forward. With that, we thought it would be worth bringing to life one of the investments we've made more recently within the strategy. So Cable and Wireless, it's a leading TMT business in the Caribbean and Latin America. We really like this business for a number of reasons. Firstly, we like the defensive nature of the industry. We like its market position as the number one or two lead player in each of its different countries. Obviously, it's very well diversified from a geographic perspective, operating in over 21 countries. We like the dollarized revenues, which are very important to us, given that we're lending in dollars. And most importantly, the significant asset value provided by their subsea fiber optic cable network. They have around 50,000 kilometers of these cables, and our bonds are secured against these assets, which provides a lot of downside protection. We invested in these bonds earlier this year. We're getting a close to 8% yield to maturity for a company for the next, let's say for a bond that matures in 2032. So we think a very, very attractive risk-adjusted return for the type of quality business that we're looking at. So what does that mean at a strategy level? And what are our expectations for returns over the next 12 months? We thought it'd be interesting to build a return simulation based on various US Treasury yields and credit spreads expectations. You can see that if yields and spreads remain unchanged from current levels, the strategy is expected to deliver a nearly 9% yield over the next 1 year. Our base case is for returns to be somewhere in the red box. So with Treasury yields, from the 4.5% to 4% range, and with credit spreads also range bound from the 200 to 250 basis point mark. However, if you expect a significant widening in credit spreads and/or a widening in US Treasury yields, the strategy should still deliver positive returns, as shown in the top left corner of this table. This is supported by, again, our attractive income yield, our yield to maturity, and the short duration of the strategy.